Why Japan's $70 billion plus intervention and a rate hike didn't prop up the yen more. June 21, 2026. Japan has spent more than $11.7 trillion, $73 billion, on foreign exchange intervention, and the Bank of Japan, BOJ, has raised interest rates to their highest level in over 30 years, yet the yen remains weak, trading near $160 per US dollar. This has left Finance Minister Satsuki Katayama facing growing pressure as efforts to support the currency have produced only limited and temporary results. Analysts say the main reason is that the yen's weakness is driven by deeper structural factors rather than short-term market moves. Although the BOJ's rate hike marked a shift away from ultra-loose monetary policy, it was widely anticipated by investors. As a result, the move had little impact on currency markets. According to State Street strategist Masahiko Liu, the rate increase acted more like a temporary fix than a lasting solution. Japan's intervention strategy has also faced challenges. Officials repeatedly warned in early June that they were prepared to take decisive action against excessive yen volatility. However, by signaling their intentions so clearly, they reduced the surprise factor that often makes interventions more effective. Markets were therefore better prepared for any official action, limiting its impact. Evidence of intervention emerged in late April when the yen suddenly strengthened from around $160 to $156.6 per dollar, and then briefly to $155. Market participants also believe authorities intervened again during the Golden Week holidays in early May when the currency weakened toward $158. Despite these efforts, the yen soon resumed its decline and returned close to the $160 level. A major factor behind the persistent weakness is the large interest rate gap between Japan and the United States. While Japan has begun tightening policy, U.S. bond yields remain significantly higher. 10-year Japanese government bonds yield about 2.64%, compared with roughly 4.45% for U.S. Treasuries. This difference continues to encourage carry trades, in which investors borrow cheaply in yen and invest in higher-yielding overseas assets. Such activity increases selling pressure on the Japanese currency. Politics is another important influence. Prime Minister Sanai Takaichi's administration is viewed as favoring reflationary policies that support economic growth through relatively accommodative monetary conditions. This stance has created uncertainty about how aggressively the BOJ will tighten policy in the future, discouraging capital inflows that might otherwise strengthen the yen. The government's recent appointments to the BOJ board have reinforced that perception. New board members Toichiro Asada and Ayano Sato are associated with reflationist views that favor expansionary fiscal and monetary policies. Asada was the sole dissenter when the BOJ voted to raise rates, highlighting divisions within the central bank over the pace of policy tightening. External economic pressures have also weighed on the yen. Japan remains heavily dependent on imported energy, and elevated oil prices linked to conflict involving Iran have increased demand for dollars to pay for energy imports. This has further weakened the Japanese currency. In the near term, analysts believe the likelihood of additional intervention remains high because speculative bets against the yen have grown to levels exceeding those seen before earlier interventions. However, the longer-term outlook may be more favorable. A potential easing of Middle East tensions could reduce Japan's energy import costs, while increased foreign investment in Japanese stocks, AI-related industries, and technology companies could attract capital into Japan and provide stronger support for the yen over time. By CNBC, story by Lim Huijia, June 20, 2026.